Gold just crossed $5,100 per ounce. The same Wall Street analysts who called it overpriced 2 weeks ago are now quietly flipping bullish. And a 15-day ultimatum to Iran just made every single dollar you hold worth less than it was yesterday. What are they not telling you? Welcome to the Capital Anchor. I break down what is actually happening in markets while mainstream media keeps you distracted with headlines. If you are new here, subscribe right now because what I am about to show you could permanently change how you think about money and safety. Let us start with what just happened. On February 19, 2026, gold reclaimed the critical $5,000 per ounce level. By February 20th, it pushed to $5,018 in. Spot markets and futures were trading even higher. The Kitco News Weekly Gold Survey, published February 20th, confirmed something remarkable. Wall Street bears analysts who had been calling for a pullback turned tail completely. The same professional money managers who expected a correction are now calling for higher prices. Main Street investors never flinched. Regular retail participants stayed bullish throughout the entire volatile stretch, that gap between Wall Street's flip and Main Street's consistency tells you something important about who actually understands this market right now. Here is the specific trigger that moved prices. On February 19, President Trump issued a definitive 10 to 15-day ultimatum to Iran. The demand was clear: dismantle uranium enrichment capabilities and agree to a permanent nuclear freeze. If Tehran refuses, the U.S. military is prepared to act. To aircraft carrier strike groups, the USS Gerald R and the USS Abraham Lincoln are already positioned near the Strait of Hormuz. That is not a bluff, that is a posture, and markets understood it immediately. Brent crude jumped 1.6% to $71.49 per barrel. U.S. crude rose 1.74% to $66.18. Gold moved above $5,050 in early Friday trading. Oil prices hit their highest level in nearly 7 months. Now here is the number that most people completely missed. About 20 million barrels of oil pass through the Strait of Hormuz every single day. That is 20% of the entire planet's daily oil consumption flowing through one narrow waterway. Ole Hansen, head of commodity strategy at Saxo Bank, described it directly. The world's most important oil artery now sits within striking distance of a conflict. Think about what that means for inflation. Think about what that means for rate cuts. Think about what that means for gold. Here is the mechanism most retail investors do not understand, and it is the core of everything happening right now. Imagine a seesaw. On one side sits the US dollar, on the other side sits gold. The weight that tips the seesaw is confidence in global stability, confidence in U.S. policy, confidence in the purchasing power of paper currency. Right now, every piece of news is adding weight to the gold side. The dollar recently fell to a 4-year low, down approximately 11% over the past year. The Supreme Court struck down Trump's sweeping global tariffs on February 20th, adding fresh uncertainty about U.S. trade policy going forward. The Fed is pausing rate cuts because inflation in January was still running at 2.4%, and now a possible military conflict with Iran threatens to push oil prices sharply higher, which would reignite that same inflation the Fed is trying to contain. Every one of those forces tips the seesaw the same direction, away from the dollar, toward gold. This is not one reason. This is a coordinated structural shift. Let me break it down. Reason number 1 is geopolitical risk premium becoming permanent, not temporary. Capital economics analysts wrote explicitly that strikes on Iran would risk causing oil prices to jump and threatening to boost inflation worldwide, reducing the pace or number of interest rate cuts by major central banks. When geopolitical tension directly threatens the global oil supply, markets do not shrug it off. They price it in, and that premium does not disappear when tensions ease, it simply sets a new floor. Reason number 2 is the dollar's structural deterioration. A currency that falls 11% in 1 year is not experiencing temporary weakness. The Bloomberg Dollar Index is under sustained pressure from tariff uncertainty, rising U.S. debt levels, and global de-dollarization flows. Goldman Sachs senior commodities analyst Lena Thomas stated clearly in February 2026 that Goldman's forecast does not even account for further diversification flows into gold beyond central bank buying and Fed cut-driven private investment, meaning their $5,400 year-end target could be exceeded significantly. Reason number 3 is the structural shift in gold's safe haven status. Gold surged 64% in 2025, a year defined by Trump's return to the White House and the radical reshaping of global trade and institutions. Al Jazeera reported that gold's stellar run has been aided by the declining appeal of traditional safe haven assets like government bonds, whose credibility has dimmed amid anxiety about massive debt held by advanced economies, including the United States. When bonds stop being safe, gold absorbs that capital. Now here is the moment where you need to pay close attention. While retail investors were watching headlines and waiting for a pullback, the institutions were repositioning. Deutsche Bank called gold's rally structural and forecasted $6,000 in 2026. Stated the $6,000 level could look conservative if Fed rate cuts continue and U.S. military action against Iran becomes reality. UBS set a base case target of $6,000 and an upside scenario of $7,200. Wells Fargo raised its year-end gold price target to $6,300 in February 2026 and advised clients to buy the dip. Meanwhile, Bank of America predicted gold would hold flat at $5,000. GBC and Commerzbank expected prices to average in the mid to high for OOOS. Read that again carefully. The most bearish institutional estimates are still calling for prices near where gold was trading just days ago. The most bullish are calling for $7,200. This is the disconnect that matters. While mainstream financial media spent weeks warning retail investors that gold was overbought and overpriced, the largest banks on the planet were revising their targets upward. A Reuters poll of 30 strategists showed a median 2026 gold forecast of $4,746 a number gold. Already exceeded by more than $300, the consensus was behind reality. That is exactly how wealth transfers happen, not dramatically, quietly. While you were reading about gold being too expensive at $4,500, institutions were loading positions for $5,400, $6,000, and beyond. And the Kitco survey confirmed what that institutional repositioning looked like in real time. The Wall Street bears the same voices who told you to wait, to be cautious, to expect a correction turned bullish the same week gold crossed $5,100. Main Street never wavered. Regular investors, the ones without Bloomberg terminals and institutional research desks, stayed consistently bullish through the entire volatile stretch between $4,400 and $5,100. In this market, Main Street was right. Wall Street was catching up. But here is where it gets truly interesting. Because what happened this week is not the full picture. What is coming in the next 15 days could change the entire trajectory. The pattern playing out right now is not new. It has happened before, and knowing what came next is the most important thing you can do with this information. Go back to August 2020. The world was drowning in pandemic uncertainty. The Federal Reserve had slashed rates to zero. Governments were printing trillions. Gold broke through $2,072 per ounce, a record high that stunned analysts who had been calling it overpriced at $1,800. What did most retail investors do? They waited for a pullback that never came to that level. What did institutions do? They were already positioned. Gold did not look back below $1,600 for more than 2 years. The current setup mirrors that moment almost exactly. A global shock, geopolitical this time instead of biological, a weakening dollar, a hesitant Federal Reserve, and institutions already repositioning before retail investors have finished reading the headlines. The World Gold Council's 2026 forecast predicts gold could gain 5 to 15% if rates drop further, or 15 to 30% if there is a significant economic downturn. CNN gold is already trading at $5,100. Run that math. A 15% gain from here puts gold at $5,865. A 30% gain puts it at $6,630. Those numbers are not speculation. They come directly from the World Gold Council's own projections. Now here is what has not changed regardless of short-term volatility. The structural forces that have been driving gold since 2022 are still fully intact, not partially, fully. Central bank demand for gold is projected to average around 585 tons per quarter in 2026, comprising approximately 190 tons per quarter from central banks alone. Kitco, even with gold above $5,000 per ounce, central banks are not slowing down. They are buying less in tonnage terms because at $5,000 per ounce, you need fewer tons to hit the same dollar allocation target. The demand is structural, not discretionary. The Supreme Court's decision limiting tariff authority has led investors to reassess the federal government's revenue outlook, if tariff-related. Income declines in 2026, the Treasury will likely need to issue more debt, increasing supply at the long end of the curve, CNBC more debt. Higher term premiums, weaker real yields, every single one of those outcomes is a tailwind for gold. The Federal Reserve is paralyzed. January inflation came in at 2.4%, still above target. Fed Chair Powell cannot cut aggressively without risking a second inflation wave. His term ends in May 2026, and the incoming leadership is expected to lean more dovish. That transition alone adds uncertainty to markets, and markets that are uncertain about monetary policy move toward gold. And then there is the Iran variable, 20 million barrels of oil per day, one narrow strait, a 15-day ultimatum that expires within days of this video. If military action occurs, oil prices surge past $80 per barrel, inflation reignites globally, rate cut timelines collapse, gold absorbs every single dollar of that uncertainty. Now, on the record, screenshot this. Gold will reach $6,000 per ounce before September 30, 2026. The combination of a weakening dollar, central bank buying at 585 tons per quarter, Fed leadership transition uncertainty, and active Middle East military risk creates a floor, not a ceiling at current prices. Deutsche Bank reiterated its $6,000 per ounce target on February 2, 2026. Now expects $6,000 by year-end, stating this may be a conservative estimate. Kitco Wells Fargo's year-end target is $6,300. This is not one bank's opinion. This is a convergence. Come back to this video when it happens. Now the scenarios, 3 outcomes, with real probabilities. Scenario 1: Iran accepts the ultimatum, tensions de-escalate, oil pulls back. Gold sees a short-term correction to the $4,700 to $4,900 range. But the structural forces, dollar weakness, central bank buying, Fed uncertainty remain intact. Gold consolidates and resumes higher by Q3 2026. Probability, 35%. Scenario 2: Iran refuses, U.S. conducts targeted military strikes, oil spikes past $80, inflation fears reignite. Gold surges past $5,500. Within 30 days, the Fed delays rate cuts indefinitely. Gold reaches $6,000 before summer. Probability, 45%. Scenario 3: Prolonged military engagement, global oil supply disruption, Strait of Hormuz partially blocked, oil moves above $100. A full-scale financial shock hits markets. Gold surges past $6,500. The dollar loses safe haven status temporarily. Central banks globally accelerate gold purchases. Probability, 20%. Add those probabilities up. In 80% of scenarios, gold is higher from here. In only 35% does it dip meaningfully before recovering. The asymmetry is obvious. Now let us talk about what you should actually do depending on who you are. If you are holding physical gold, do not move. Your position is validated by the data, the institutions, and the macro backdrop. The only question is patience. The people who sold physical gold at $4,500 waiting for a pullback are now watching it trade at $5,100. If you are using leverage or trading actively, the Iran 15-day window is your risk event. Military action triggers a rapid price spike followed by a sharp volatility surge. Tight stops, defined risk, no overnight exposure without a clear plan. The spike will be fast, so will the reversal if de-escalation occurs. If you are sitting on cash, the window is not closed but it is narrowing. A correction to the $4,700 to $4,900 zone, if it occurs in Scenario 1, is the entry most patient investors have been waiting for. Do not chase the current price, define your level and respect it. If you bought at what felt like the top and you are underwater on a recent position above $5,000, understand this. The institutions covering gold are not calling for a structural reversal. Volatility is not the same as a trend change. Manage the position, do not panic out of it. Now here is what to watch going forward. 4. Specific indicators. Watch the DXY, the US dollar index. If it continues to fall below the 100 level, gold has room to run. If it bounces sharply, expect short-term gold selling pressure. Watch the Strait of Hormuz shipping reports. Any disruption to tanker traffic is a direct signal that oil and gold are about to reprice significantly higher. Watch COMEX gold inventory levels. Sustained drawdowns in physical delivery inventories confirm that institutional demand is absorbing supply, not speculative positioning. Watch the Fed chair nomination. A dovish replacement for Powell, confirmed before May, accelerates the rate cut timeline and is immediately bullish for gold by at least 5 to 8%. Now, 3 types of people are watching this video right now. The first type is panicking. They saw gold pull back from $5,100 and they are wondering if they missed the move. They are checking prices every 30 minutes and second-guessing every decision they made. The second type is frozen. They have been watching gold. Since $3,500, they keep waiting for the perfect entry. They watched it pass for $1,000, then $4,500, then $5,000. They are still waiting. The third type is learning and preparing. They are not reacting to every price stick. They understand the mechanism. They know the structural forces. They are building a plan based on data, not emotion. Every market cycle transfers wealth from the first 2 types to the third. Markets do not reward the loudest or the fastest. They reward the prepared. While most investors were reading headlines about gold being expensive at $4,000, patient and informed participants were building positions. While Wall Street analysts were forecasting pullbacks, Main Street investors were holding firm, and they were right. The gold story did not start this week, and it will not end this week. What started this week is the next chapter, and the 15-day ultimatum to Iran is the chapter title. You came into this video knowing gold crossed $5,100. You leave it knowing why, who saw it coming, and where the 3 most likely paths forward lead. Like this video if the data made something click for you. Subscribe to Capital Anchor because the next move in this market will not be announced on mainstream news until after it has already happened. Share this with one person who is sitting on cash and wondering whether they missed the gold trade, and drop one word in the comments. Right now, type prepared if you are in the third category, or type learning if this video is changing how you see the market. The wealth transfer is already happening. The only question is which side of it you are on. This video is for informational and educational purposes only and does not constitute financial advice.